Everyone loves a 500% gainer. But is India Glycols really worth buying, or are we chasing ghosts? So hello everyone, I am Tamandeep and today we are going to continue our analysis of India Glycols. In the last video we found a lot about the numbers, we crunched them and we saw that India Glycols has a promising growth but is under a huge financial burden. So what to do now? Let's continue and see if it's really worth buying. So let's continue with valuation. In valuation, we'll see two parts: peer comparison and PEG ratio. Yeah. So in peer comparison, the PE ratio of IGL stands at 22.17%. PE ratio is price per stock over earnings per stock. So what does this ratio tell us? To be honest, this ratio tells us nothing. But when we compare this ratio with its peers in the market, we can get a lot of information. This ratio is always used in comparison, maybe from the past of the same company, maybe its peers. Yeah. So PE ratio of Deepak Nitrites is 40.58. That's nearly double. Why is IGL's PE ratio far less than its peers' PE ratio? There can be two possible reasons, right? Maybe market has not yet understood the value of IGL. Maybe market is a bit afraid because of its financial burdens. So out of these two possible explanations, which is the correct explanation? I say both are correct. See, world is not white or black, right? Both contribute to some amount of its P ratio being less. Yeah. So let's continue the PEG ratio. Yeah. So PEG is price to earnings to growth ratio. Okay. So the point to remember here is if the PEG ratio is less than 1, the stock is undervalued. And if the PEG ratio is more than 1, the stock is overvalued. And as we can see, the PEG ratio here is less than 1. Guys, this is really good news for the stocks. Yeah. So we have also understood the valuation. So I say we have done a lot of numbers. Yeah, we are practically understanding everything that's on the paper to know about. But what about the ground reality? What happens on ground? So for that, let's go to risk and reward analysis. Yeah. Starting with the growth catalyst. So IGL promised two things: adding a 100 kiloliter per day capacity to its grain-based distillery in the second phase of its expansion, and it also promised a 5,000 metric ton per year capacity addition to its facilities of producing chemicals. So such improvements usually affect highly positively on the stocks. So that's good. What are the risks? There are a lot of risks with the stocks. Yeah. Starting with the execution risk. See, they are making big promises. If they will not be able to execute such promises, their share price will drop a lot. So that's a big issue here. Yeah. Moving on to regulatory risk. See, the bottom line is even though they are going towards the green projects, still their major earning is from liquor. Yeah, which is highly regulated. As we can see in 2016, Bihar became a dry state and there are extraordinary taxes on liquor, especially in areas like Bangalore, right? So such regulations can highly affect its income flow. So that's not good. And finally, the biggest risk, liquidity risk. See, they are working at 90% capacity. Yeah, capacity in the sense they are spending 90% of their earning here. In fact, their current ratio is less than 1, which means their current assets are less than their current liabilities. It's a big question mark on the stock. So now that we understand the risk, we also understand its powers, its growth. Let's see if they are actually able to execute. For those who haven't noticed yet, all the data that I am showing is a bit old. Not old enough to be irrelevant, yet it's a little bit old, so that we can validate their promises. Yeah, practically everything was related to financial year 2025, their promises and all their projections. And we are in financial year 2026, so we can validate were they able to do that. So first, they promised to bring their net debt to PBIL DT ratio less than 4.5 by end of financial year 25, and they did that. Operational capacity is full. All the promises that they made about increasing the capacity were done. There were a few fluctuations in the dates there. Nevertheless, they did execute. They did deliver. Yeah. So earnings surge. Their increase in earning continues even as we speak. So that's really good. If you remember, originally we claimed about 18% increase in earnings. Now it's more than 20%. So that's even better. Yeah. So apart from this, they were also able to secure a contract of providing ethanol for ethanol blended petrol program by the government of India, right? As much as I hate that program, this is a really good news for our stocks here, for India Glycols stocks here. Yeah. Apart from that, they were also able to enter into a partnership with Amrut Distilleries. Those who don't know, Amrut Distilleries is one of the biggest name in Indian whiskey market. It's really huge. So we crunch the numbers, we know the ground reality, their risks, and their new potentials of earning, like Amrut Distillery partnership. Yeah. So what is the conclusion of the stock? I say conclusion is up to you. See, I told you all the facts, and the fact is that India Glycols is nowhere a safe stock. So if you ask for my personal opinion, I say if you like to diversify your investment from low risk to and low earnings to high risk and high earnings, this could be a good addition to your high risk high earning stocks. But if you don't invest in that way, then keep this stock on hold. It's risky. It has potential of being a multi-bagger, but it's still risky. And guys, remember, your research does not end here. It starts here. Yeah. Do your own research always before buying a stock. And that's it for today. Bye.